The Advanced Micro Devices stock, NASDAQ AMD, is currently trading at $237.52, reflecting a moderate intraday move of plus 0.76% as of the latest market check, right in the middle of a consolidation period that has defined the last few sessions following a significant spike. Now, the common expectation you hear about AMD is simple. It's the clear number 2 to NVIDIA in the massive AI accelerator market, and its growth is all about closing that gap. That's the narrative that drove the stock up over 100% year-to-date earlier in the year. But here is the deeper insight you need to consider that the quick-to-judge market often misses. The real leverage for AMD right now isn't just in the headline-grabbing high-end MI300 series GPU sales, but in the rapidly expanding moat around its entire data center portfolio, especially the resurgence of its EPYC server CPUs and the often underappreciated strength of its client and embedded segments, which are all being fundamentally altered by the inclusion of AI capabilities at every level. The market tends to treat the GPU story as a single lever, but the reality is the increasing synergy across all of AMD's product lines is what's quietly cementing its position for long-term profitable growth that extends far beyond the current AI hype cycle. Think about the general sentiment. Investors are looking for any sign that AMD can effectively challenge the market leader. And when the most recent Q3 earnings report landed, the reaction was telling. The company reported record revenue of $9.25 billion and non-GAAP EPS of $1.20, beating Wall Street expectations across the board, with data center revenue hitting $4.3 billion. Logically, those numbers should have sent the AMD stock price soaring, yet we saw a distinct initial pullback, a classic case of expectation falling slightly short of reality. The expectation was for the AI chip acceleration to be so overwhelming that it would defy all gravity, but the reality was a more measured, though still spectacular, beat. This lukewarm initial response was a reaction to the guidance. Strong, yes, but not the earth-shattering number some analysts had built into their overly aggressive models. This dip, however, created an immense buying opportunity for institutional investors, who have been net purchasers, with over 1,000 institutions adding to their holdings in the most recent reported quarter. That institutional vote of confidence tells you that the smart money is looking past the quarter-to-quarter guidance noise and focusing on the underlying structural story. The volatility, even on good news, is a symptom of a highly valued, highly watched stock operating under a microscope. Retail investors using platforms like Robinhood or SoFi Invest might see a slight dip after great earnings and panic, but the long-term players see consolidation before the next leg up. The recent stock movement perfectly encapsulates this tension. The shares have traded in a relatively tight band following the earnings release, showing significant resistance near the 250 level while finding solid support in the 230 to 235 range. This behavior indicates that every downward move has been met with fresh buying pressure, confirming the underlying belief in the company's future. The trading volumes have been substantial, well above the daily average in the weeks surrounding the Analyst Day and the Q3 report, suggesting a high level of activity not just from day traders but from larger funds rotating capital. The semiconductor sector as a whole has enjoyed a strong period, partially driven by the insatiable demand for the foundational components of artificial intelligence, which also benefits competitors like NVIDIA stock. But AMD's specific momentum has been amplified by key product announcements. Specifically, the company's Financial Analyst Day in New York was a major catalyst, where they detailed a long-term strategy targeting a greater than 35% revenue compound annual growth rate, a massive projection that caught the market's attention. The market's expectation was for incremental improvements. The reality delivered was a completely new and highly ambitious financial model. This announcement, projecting non-GAAP EPS to exceed $20 in the long term, provides a concrete anchor for future valuation, fundamentally shifting how analysts view the stock. To understand why this is a deeper story than a single chip, we need to quickly look at the foundational business. Advanced Micro Devices designs and produces high-performance central processing units, CPUs, and graphics processing units, GPUs, for the data center, embedded, client, and gaming markets. The company operates in 4 main segments. The data center segment, which includes EPYC server CPUs and Instinct accelerators, is the clear engine of current and future growth. The client segment focuses on Ryzen desktop and notebook processors and is critical for market share battles against its main CPU competitor. The gaming segment is well known for its Radeon graphics cards and the custom chips that power leading consoles. Finally, the embedded segment, encompassing products from the acquisition of Xilinx, provides solutions for industrial, automotive, and communications markets. The business model relies on a fabless approach, meaning they design the chips and outsource the manufacturing to third-party foundries, primarily TSMC. This structure offers flexibility but also introduces supply chain risks, a fact that was hinted at in the Q4 guidance. Historically, AMD was seen as a perennial underdog, but under the leadership of Dr. Lisa Su, it has staged one of the most remarkable corporate turnarounds in recent history, steadily gaining market share in both the CPU and GPU spaces. Their past performance shows a consistent trend of execution, turning what was once a highly speculative stock into a legitimate high-growth contender in the technology sector, leading to its inclusion in many diversified funds, including Fidelity ETFs and those managed by Fidelity Wealth Management. Now, let's circle back to the future outlook and the expectation versus reality dynamic. The expectation is that AI is a two-horse race, and AMD will simply chip away at the leader's dominance. The reality is that the market is fragmenting, and AMD is positioned to dominate the open ecosystem side of AI. Their recent strategic partnerships are a clear illustration of this. The headline-grabbing deals with OpenAI and Oracle, which will deploy vast numbers of their next-generation MI450 GPUs, are not just about shifting units. They are about establishing AMD's MI series and the ROCm software platform as the foundational backbone for open, scalable AI infrastructure, directly challenging the closed system dominance of the current market leader. The sheer scale is staggering. Supplying up to 6 gigawatts of GPUs to OpenAI alone, with Oracle deploying 50,000 GPUs, is the kind of commitment that signals a deep, sticky integration into the core infrastructure of the largest cloud and AI players. These rack-scale system deals, like the Helios design, are what analysts like Morgan Stanley are calling the key to the next growth phase. A significant leap beyond selling individual components. They are selling entire solutions, which drastically increases the barrier to entry for any new competitor. The risk, of course, is execution. The biggest overhang for the AMD stock price has always been the question of whether they can deliver on the ambitious roadmaps, especially on the software side, where the competitor has an entrenched lead. Can the ROCm platform truly become the viable alternative to the industry standard for AI developers? The market is betting heavily that they can, evidenced by the high PE ratio, which reflects a tremendous discount of future earnings into the present stock price. The $1 trillion compute market size projection that AMD discussed at its Analyst Day is not an arbitrary figure. It's a structural argument that the demand for silicon will continue to outpace supply for years to come, providing a massive tailwind. This long-term growth story is why we see platforms dedicated to self-investing, such as Schwab Intelligent Portfolios and Intelligent Portfolio offerings, increasing their allocation to the semiconductor sector. Furthermore, even in the non-AI segments, the company is targeting greater than 10% revenue CAGR for its client, gaming, and embedded businesses, driven by market share gains and the expansion of the AI PC segment with chips like the Gorgon and Medusa processors. These are not secondary markets. They are massive, consistent revenue streams that provide a cushion against any temporary deceleration in the high-end data center space. To wrap this up and get a sense of where you stand on this semiconductor heavyweight, comment below with whether you think AMD will hit its self-imposed $20 non-GAAP EPS target faster than Wall Street expects, and if you currently hold more NVIDIA stock or AMD stock in your individual brokerage account.